We started there at this resistance that has lasted for over decades now. And we're very, very close to a breakout in this chart. This could happen any month, really.
Hi, I've got a very special guest with me, Tavi Costa from CrescatCapital.net. And Crescat is CRESCAT.net. Tavi, how are you doing?
I'm great, Mike. How are you?
Excellent. You know, I was looking at your newsletter from last month, and it has this great silver chart that's showing that we could be in for a massive breakout sometime soon at the very end of the presentation. So I want to tell our viewers, you got to stick around to the end for this one. But you've got all of the charts from your last newsletter, plus a few more that you've added to it. You just showed me this presentation. So why don't we run through this? Tell us about, you know, one of the things that is in the newsletter. It starts out with a very easy chart for the public to understand, and it's alarming. So, and it's something that I've been warning about since they started raising rates at the fastest rate in history. I mean, I started talking about this about a year ago. I was talking about how fast they were raising rates and showing year-over-year changes that had never been seen before, percentage-wise. So show us that first chart and tell us about it.
Absolutely. Well, this first chart is just looking at the interest payment on the federal debt, which I think the chart itself has been going around more recently, and its surge in cost of debt that we're seeing in the US and other developed economies, given the fact that yields are rising. But more importantly, is starting to constrain other parts of the fiscal agenda, meaning we're starting to see the payment on the debt actually surpass some parts of the fiscal stimulus, such as defense spending in this chart, as you can see today, is now lower than the interest payment. And we haven't seen anything yet. I mean, this whole report really describes this idea that if you just look at interest payment today relative to fiscal spending, is only 10% of it. So we're yet to see that surge to much higher levels as the debt matures, and we see more of the debt getting rolled over at higher interest rates. As we see more issuances of this debt problem that we're seeing in this fiscal dominance, type of strategy across most of the developed economies in the world today. And this is going to become, more and more relevant over time. And I'm very concerned about the overall debt problem in the U.S.
So am I. When this data set that you've got, what month does this end on? Because this isn't like this month. Is this last month or the month before or the month before that? Because by the end of 2023, I think we're going to be well over $1 trillion.
Absolutely. I mean, if just looking at this chart itself, this is actually from June. If we go back to a chart that shows this chart, for instance, which is going to be a big part of why that line is going to surge even more, is the debt maturity problem. You know, when you look at the debt itself, about 45% of the debt. So you're looking at here, this chart is just looking at the maturity of the overall debt in the US. And about 45% of the debt in the US is going to mature. There's nothing we can do about that. And so they're going to have to reissue that debt because the government is not in a position where revenues are actually surpassing their spending. And so as we see that, that is likely to create further pressure on that red line, which is the interest payment, to go even further to the upside. And so it is going to be a bigger problem. We're going to have to be growing the economy at much higher levels than 3% of GDP just to pay down the debt. And that is, 3% is as of today. So it's going to be significantly higher as we move along. And so it is going to be quite, a real issue that is going to have implications on financial markets in general.
Yes, it is. So let's move on to the next chart, because you have a lot of what is going to impact the economy and the health of the economy here. So, okay, twin deficits to GDP. Tell us about this. Well, the current account deficit and the fiscal deficit.
That's right. That's right. So, we often look at just the fiscal deficit, which is just what the government's spending relative to the revenues. but it's also important to look at the side of trade balance, meaning exports versus imports, which is the current account that you just mentioned.
Plus foreign investment, right? Exports
Correct.
versus imports plus foreign investment. Yeah. Okay.
Yes. Although majority of the current account really is just imports versus exports, in which oil plays a big role into that. We're selling our strategic petroleum reserves, in which majority of the selling has happened in the sour type of crude, which means we have to import more of those over time, and it worsens the current account problem. So when you add both right now, you can see that we're close to 12% of GDP in this twin deficit issue. And it is as bad as it was, during the global financial crisis at the very depth of that recession. And I think more importantly, although this is, concerning from a perspective of the compounding of the debt problem that we're seeing, while we're compounding this at basically 12% annual rate. More concerning is how in this chart you can see the tech bust and the global financial crisis and the pandemic recession. Well, note that there is a trend. We're doing higher or lower lows in this measurement. In other words, the twin deficits to GDP is worsening after progressively with recessions. And so I think this is a structural problem. We haven't even seen a recession. We are already at the global financial crisis levels. And I think this is very meaningful for the dollar, for tangible assets, financial markets in general. So we're probably going to see much lower levels in this.
Right. Well, yes, it is a chronic problem. You can see on this chart that it has never gone positive. This is always in negative territory. And you can't do this unless you're the world's reserve currency. This is a privilege that this constant being able to run these current account deficits. When a country that doesn't have the world's reserve currency does this, they end up with some big currency problem and basically going bankrupt. They go through a hyperinflation or they go through something like that. There's a crisis. It ends in a huge crisis. And this is just very bad habits. And to me, I think that everyone, our politicians in Washington, there's a few of them, and I mean a few of them that you can count on your fingers. The rest of them should be in jail. This is treasonous to continue policies that support this, and now they're undermining the world reserve currency status of the U.S. dollar. So let's move on to the next chart, and you can. Oh, before that, go back to that chart one second. It's interesting that even with the pandemic, you can practically draw a trend line across the bottom of this, and the fact that this is getting worse and worse. We're basically having a party in the United States, and it doesn't just end with a hangover. We don't realize that one of the guests has a bomb strapped underneath his vest. This is going to end badly, and I think suddenly someday. I mean, look at the plunge that happened during the pandemic. I think that someday there's something out there that's just going to kick off a cascading event, because we keep on making our whole monetary system and financial system more and more fragile. And it's going, when we go to digital currency, then it's completely reliant. There's single points of failure. The internet, power, it becomes very, very dangerous. Anyway, let's move on to your next chart. Do you have any other comments on that?
No, what I would say is today, I think we're seeing quite a lot of financial analysts and supposedly experts saying that this is likely to play out very similar to 2011, when we had the downgrade as well from the Standard & Poor's in terms of the U.S. Creating credit agency and so forth. And it was concerning at the time, but it's completely different what we're seeing today. The degree and magnitude of Treasury issuances, the size of the government itself, the size of the Treasury market, and the fact that we're not seeing foreign holders of those treasuries, meaning central banks from other places, really being the buyers of those instruments. And so that is, it couldn't be more different, even from a valuation perspective of the market as well. So I think this is likely to be a much higher issue, or much more concerning problem than it was back in 2011. I feel very strongly about that.
Yeah.
But this chart is just, a lot of people like to, in the macro world, like to look at fiscal impulse. Fiscal impulse just is the rate of change of the government spending, meaning how much is the government stimulating or trying to stimulate the economy. And it's important to exclude the interest payments from this measurement, because obviously that is sort of the nature of that spending, where we're seeing across defense, our military expenditures. We're seeing also the Green Revolution, social programs at the levels that we haven't seen in the past. And so all those things are playing a role into this fiscal impulse that is now back up to about 15% of GDP or growth. And you can see here that every time we've had that, it was also occurring during a recessionary environment. We're not in a recessionary environment yet. Maybe we can see some of that data is conflicting. I can maybe argue that we are in a contraction already in the U.S., but certainly not officially from a government standpoint, which it doesn't really matter. But we can see that equity markets are not behaving like we're in a recession. So I guess that's the bottom line there. And the economy is concerning. I mean, who is going to be buying all these treasuries at these levels of fiscal spending that we're seeing? This is completely absurd. Again, it ties back to the tangible assets idea of owning instruments that are not being issued at the degrees that we're seeing in the Treasury side. But also it will create a lot of opportunities in structurally higher interest rates in the economy.
Okay, so let's move on to your next chart. Okay, so this is one of the symptoms of what you were, one of the causes of what you were talking about. So, yeah.
Correct, because the government, like any other company, if you don't have, if you don't have revenues, you have to issue debt. You either issue debt or equity. From a company perspective, the government doesn't have the luxury of issuing equity, so it has to issue debt. And so we're seeing majority of that happen in the short-term instruments, which is called the T-bills. And so $802 billion is actually an outdated number. This number today is closer to $1.3 trillion that we've had so far this year. And majority of that, people think it's just coming from short-term, but it's not true. If you look at long-term maturity debt issuances, it has been tremendous as well. I mean, almost $90 billion in the last 2 months. We're yet to see what that amount was in a prior month. And so now I try to keep track of this data as close as I can. And this is, one reason when I hear a lot of analysts saying that the reason why 10-year yields are rising is because we're going to see a soft landing and the economy is doing better. That has nothing to do with that. It's all to do with the flood of issuances of treasuries that we're seeing. So this chart just shows that, I guess.
Okay, so long term, you're talking 10, 20, and 30-year treasuries, right?
Correct.
Okay, so what people don't realize about treasury issuance is that these are certificates of enslavement. They have to extract taxes out of, I have no problem with corporate bonds. A corporate bond is a company saying, loan us your capital for a specific period of time, and we are going to work our asses off to create some great products that customers are going to want to buy, and out of the profits from basically making life better for everybody by helping GDP and everything else, out of those profits, I'm going to pay you back. When the government, when you invest in a bond, you are investing in it's basically the slave trade. You are investing in the government having, you have to work. It's like forcing somebody to work with no compensation. So you're forcing them to work for the benefits of somebody else for no compensation. And that is basically the definition of slavery. I don't know any other word that I could use except slavery. And, you know, I have a moral issue. I would invest in bonds, but I just can't let myself do it because I see the world this way. So these long-term bonds that they are selling every day is not just enslaving you, but this is 30 years. It's enslaving your children and potentially grandchildren.
That's right. And by the way, you know, this announcement by the government recently, the Treasury Department, which is in line with what you just said, they're going to be issuing another $1.85 trillion in addition to what they've already done this year. In addition to, as well, the fact that they have to roll their current debt, 45% that will be maturing in 2 years from now, which was one of the first charts I showed. It is absurd. I don't know who is going to be the buyer of all this. I think this chart just puts into perspective how much of that we're seeing. In 2020, in the pink line, it's just looking at the increases of federal debt per year. And we saw, obviously, the economy was in lockdown, and the government decided to essentially issue a tremendous amount of U.S. debt instruments. And so we've had that government debt shooting up to levels we've never seen before, World War II levels, really. And 2023 is not too far. It's going to be pretty close. And so this is quite concerning.
Yeah, would be like the captain of the Titanic not taking evasive action, but you know, the Titanic glanced off the side of the iceberg. If it had hit the iceberg head on, it would have been even. I mean, it was a disaster either way. But this is taking that iceberg right in your sights and steering exactly towards it. This is, I believe, criminal action by the people running the government, Congress, the president, everybody. This is criminal action.
Yeah. So,
you know, in the case I was talking about corporate bonds versus sovereign debt, in corporate bonds, that was honest. This is literally criminal action. I can't remember where it was, but there was this. Yeah, it was on a YouTube channel. It was the back of a van painted. A politician is somebody that will lay down your life for their country. So, and that's what they're doing. They're just they're betraying all of us at this point.
Yeah.
The future. I mean, we're going to have this short-term party. It's going to be great. I think the markets are going to go up for at least the next 3 months. It could go into next year, but then something really devastating. And the thing is, all of these charts that you're showing us with all of this reckless spending doesn't take into account their response to whatever the next emergency is that they create.
That's right. Is the fact that, you know, if we looked at even fiscal spending relative to unemployment rate, right? Unemployment rate at record lows, and seeing how much we're spending to stimulate the economy is just, you know, it's something unprecedented. I mean, we've never seen these levels of fiscal spending relative to unemployment rate being so low ever. And so, you know, it's another point as well to your idea. Correct.
Well, it's always we're coming up to an election cycle here. And so you just kick the can down the road and it's the next guy's problem. But the energy is compounding and building up from all of these actions over the years. And this is going to come back to haunt us as something really bad. So
that's okay. Yeah, I'm going to jump into some more stuff, and feel free to change course here, Mike. But one thing that is adding to the problem is the Federal Reserve's policy in terms of their monetary policy regarding QT, and we're seeing them actually not being the buyer of last resort. In fact, we're seeing them shrink their balance sheet to levels we haven't seen in the past. And surprisingly, when you look at the Fed holdings of Treasuries year over year change right now, we are at levels that we've had them having to reverse those trends. And so it is an interesting pattern throughout history, but also completely unsustainable
Right.
to see, cost of debt rising and the Fed actually shrinking its balance sheet, or in other words, decreasing the percentage of holdings of the U.S. federal debt, which to me just seems like they're going to have to restore that fundamental role of being the financier of that government debt at some point.
Yeah, well, that comes with the next crisis, and you can bet that the next crisis, the amount of buying, the green areas on this chart is probably going to far exceed. And this chart reminds me of something I used to talk about as far as the global economy, or the U.S. economy at least, a top that's spinning perfectly at first. Like you start a new monetary system. We go on Bretton Woods, and then after a while there's a little wobble and another one, and it's becoming unstable, and they go on to another monetary system, the global dollar standard. And we're seeing that in the economy, there's all this debt-based shuffling and selling off future work hours of the population is what they're doing here. And their response, I think, will be on this chart, you're going to see a spike in the green that's higher than anything else previously when things start to really unravel.
Yeah. And keep in mind, this chart isn't a year-over-year change, which means a percentage change. If we put this in dollar terms, nominal terms, this wave over here wouldn't be in the screen at all.
Right. Yeah, it'd be way off the top of the chart.
And when we talk about, this 2011 idea, boy, I mean, we're nowhere close. I mean, this is, if anything, in terms of foreign holdings of U.S. Treasuries as a percentage of the total debt, we are in a 19-year lows right now, and we're not seeing central banks from other countries really come in and buy treasuries. And this has to do with the geopolitical tensions we're seeing. This has to do with the pressure from the amount of issuances we're seeing. And this also has to do with their own debt problems that those economies are facing because they're also running their own fiscal dominance types of policies in their own countries. And so, the fact that we're seeing central banks actually accumulate gold as a neutral asset is such an important, macro event or macro development that is, to me, one of the most important ones when it comes to investing capital today.
Yeah, yeah. This is part of the de-dollarization of the world. People don't realize when somebody talks about how many dollars China is holding, or another kind of Japan or whatever, they're not holding dollars. They're holding treasuries denominated in dollars. And so this is a chart of that, and it's a scary chart. So, okay, so let's move on.
Let's move on. I want to pass it on through those charts that are regarding more equity markets so we can focus on other things. This is a chart that, to me, it's just, when I hear people saying the economy is doing just fine, this is a state and local income tax receipts. So the revenues from income taxes that state and local governments receive. And the year-over-year change of that on a percentage basis is the second largest in history. On a dollar base, it is the largest in history, although it doesn't look like it's actually, it is the largest because I calculated this. So, but it's
well, not only that, is the crisis has not happened yet. The other two are the response to the crisis. We're digging this pit really, really deep before the bottom drops out. This is just crazy.
It's insane. I think this chart is relevant for many reasons as well regarding the position that the U.S. economy is in. It's looking at the percentage of yield curve inversions. I always thought the percentage of inversions was interesting and a topic that fascinates me, given the fact that it's something that is able to has predicted recessions in the past, but from a portfolio management perspective, it's very difficult because you get all of the signals that it may take over a year or so for you to see a recession really unfolding and really a decline in equity markets, which is what matters for anybody who is managing a portfolio. And so in 2018, I decided to create a measurement called the percentage of yield curve inversions, which is, I think it's a more comprehensive way of looking at yield curve.
It
And
is, and what I'm amazed at here is I'm looking at your notations on the bottom of the chart that this is the 30-year, the 10-year, the 7-year, the 5-year, the 3-year, 2-year, and also 12-month, 3-month, 1-month LIBOR and the Fed funds rate. So you've taken every potential note, bill, or bond that could, plus the Fed funds rate, that could possibly invert here, and you've added them all together. And so this is the truly big, and that's what I like about Crest Capital. They take a macro long view. And yeah. So, okay, yeah, tell us more about this. I'm sorry I interrupted.
No. You did a great job. I mean, you explained better than I would. And so this is just calculating the percentage of all possible spreads in the yield curve that you just mentioned that essentially are inverted. And so when you go throughout history and you see that that measurement goes above 70% every time we've had a hard landing. So when I see people betting we're going to see a soft landing in this, and I looked at the analysis in credit markets, it's very clear to me that we're going to see something a lot worse than people are expecting. More importantly, note that the percentage of inversions is rising, but very different than what we saw in the tech bust and the housing bust, because during those periods, the long end of the Treasury curve, meaning the 10-year yields, the 30-year yields, they were falling. They're basically collapsing as the short-term duration bonds yields were actually rising. And so, or at least not falling as quickly. So that was the creation or the problem of the housing bust and the tech bust in terms of the Treasury market. Today, virtually all yields are rising, and we're still seeing percentage of yield curve inversions that are higher than what we saw in the housing bust. And so this is, to me, a very classic stagflationary sign of what we're seeing so far in the economy. And to me, it's not the probability of a recession itself. It's only increasing when I looked at charts like this. And by the way, empirically, when you go above the 70% threshold in this measurement, what we found about or in our research is that you want to own gold in environments like this. You want to own gold and sell the S&P. Essentially, is that ratio of gold to S&P 500 ratio tends to perform incredibly well after the fact of seeing above 70% of threshold of yield curve inversions being breached. So here we are today, I guess.
Yeah. Okay.
Think you like this chart as well, and it's such an important development of how inflation kind of feeds on itself, and you see higher highs of inflation and the waves that it tends to go through. And by the way, this is not just the U.S. I mean, if you look at inflationary environments in Brazil, in Turkey, in Venezuela, in Argentina, in Germany in the 1920s, anything usually what you tend to see is a sign of base effects and just math, where you tend to see this wave formation into the development of inflation. And so the 1970s was no different, and today will likely be very similar. We've had a period where inflation went higher, and recently we've had a deceleration process of inflation, which I think we're very close to the end of deceleration of consumer prices. And I think we're going to start seeing a rise of that measurement one more time.
Yeah. I've often said that every dollar created has to go somewhere. So when they create currency, when they do QE and such, and when interest rates are taken down and the banks create a lot of currency, it has to flow somewhere. So something, whether it's savings or real estate or the stock market or bonds or groceries and gasoline, something has to inflate. And when we're talking about, like, this chart is tracking basically what I call groceries and gasoline. It's the stuff you buy. And what creates inflation, inflation is a phenomenon of the quantity of currency chasing the number of goods, and the velocity, and then international trade flows. And all of those things have an effect on the inflation that you see at the grocery store and the gas pump. And one of the things that people don't look at typically if you're really looking at it macro, the quantity of currency that they created during QE and then COVID, all of that has to be accounted for someday. And it hasn't yet. A small percentage has been accounted for. This chart that you're showing really makes a lot of sense to me. I think that we're in for another wave or two. I think this chart of the 70s is actually a very good way of predicting what is going to happen in the future.
It certainly serves as a guide or a model for today. And I would say that the biggest counter argument to this is, that the 70s, we didn't have the same amount of debt, and therefore it's going to play out differently. But if we look in the 40s, which was a period that we saw debt, GDP at the degree that we're seeing today, guess what? There was also an inflationary wave period in the 30s and 40s that was progressively higher. It started after the Great Depression, and we did see inflation getting progressively higher, gradually higher in rates. The peaks are higher, as you can see, and it developed in a very similar manner. And so I think this is no different. I mean, meaning, this is an important roadmap for the U.S. economy today and other developed economies. I think we're entering a world of a secular inflationary problem for many reasons, given the fact of how much fiscal spending we're seeing, the chronic underinvestments in natural resource industries, but also the wages and salaries growth that we're seeing, especially across the bottom 50% of the population when it comes to the financial classes that we have in the U.S. and other developed economies. And that is very much, I would say, similar to what we see in emerging markets, where that pressure from higher wages across lower income parts of the society really tends to create also pressure on consumer goods and services to stay elevated. And finally, I think that's similar to the 40s, which is, I think it's even more, similar in terms of the geopolitical environment than in the 70s, is this deglobalization trends that we're seeing today of countries going above and beyond to secure their own, onshore of manufacturing plants and so forth. And those things are likely to also create upward pressure in consumer goods and services.
Yeah. Yeah. Okay, let's move on.
So this is a long-term view of 30-year break-evens. 30-year break-evens, for people that don't know, is basically the market expectation for investors on where CPI is likely to be 30 years from now. You may disagree or agree with the chart, but this is just, just facts. And we're looking at basically a break of a downward trend that we've had back in 2020. This is coming out of really beginning of 2021 as we broke out. And I'll try to put my cursor over here. A big breakout of over a decade long of a downward trend, and then we've had this consolidation period of the last 2 years in which Russia invaded Ukraine. We've had issues with energy crisis. We've had a food crisis. We have so many problems developing, and yet inflation has been sort of consolidating all the energy in this chart. I think we're going to go significantly higher. And we've had a few market behavioral things happening recently that I think are interesting across oil and agricultural commodities, even gold and silver. And I think this chart is just poised to move significantly higher over the next 2 to 3 years as we see that deceleration process going away and starting to see the receleration of inflation in the second wave of that model that we were looking at in a prior chart is starting to unfold here in the following months.
Okay.
And not to go too long, so I'm not going to go through all this. I mean, this is a chart. Yeah.
This is about gold to treasuries. So I'd like to know. Yeah, this is something I want to. It just shows how much headroom there is for gold still. So
yeah.
go ahead and tell us about this chart.
No, that's a good takeaway. It also shows gold cycles in the past, how gold outperforms treasuries. It also shows,
you know, I notice almost everybody does this. They've got the 70s bull market in gold as one cycle, but you can see that it had it's a secular bull with a cyclical pullback right in the middle of it, a correction. And I consider this bull market one big bull market. I'm one of the few people out there that doesn't consider, I know it's taking a long time because, you had the upwave from 2000 to 2011, and then you have a 12-year consolidation correction, and we've broken out above the 2011 highs. So actually the correction was over with a couple of years ago. We're just in a consolidation right now, moving sideways. I still consider it all part of one big bull market because when you look at all of these different ratio charts, the ratios are just off. They aren't even, I mean, if you look at where the average was from this through the 70s through the 90s on this chart, or the early 90s, through the 80s, you can see that we're still way below that average. Anyway, so you can either talk more about this one or move on, whatever you want.
Yeah, I was just going to say one more thing is regarding interest rates, right? I mean, in the 70s, interest rates were rising too, and gold still massively outperformed treasuries during that period. I think we're going to see something similar today, and gold is extremely undervalued. And I would say treasuries are, in my view, one of the most overvalued instruments out there. And,
you can't have a bull market that has been going on since like 1980. With that's been like this perfect uninterrupted bull market. It has to be overvalued if it's that long in the tooth. There's no possibility that it isn't. So yeah,
that's right. And that ties well with the history of gold cycles chart, in which I sort of wanted to analyze history again and look back and see what were some important drivers of prior gold cycles, and why I think today is an even more attractive and perhaps even more relevant period for gold than we've seen in the past. And the first gold cycle in the 70s had a lot of its own reasons. I mean, we're in an inflationary regime. We left the gold standard, and central banks, believe it or not, were accumulating gold relative to sovereign debt. There was a lack of discoveries of gold in that period, and some of that has to do with access for capital, given the fact that interest rates are rising, and it was difficult to spend capital into, and also challenging to even find those discoveries. And then with gold prices rising so much in the 70s, we actually saw the unleashing of that, as was a large amount of discoveries in the 80s and the 90s of gold discoveries across the globe. And some of the most amazing deposits were found during that period. And then, that was a period when we saw basically gold underperform almost every asset class for 20 years. And at the very bottom of that period was during the tech bust, in which that cycle itself was completely different. I mean, we didn't see an inflationary regime like we saw in the 70s. Central banks were not accumulating gold during that period.
They were selling.
We saw something different. What's that? Sorry?
They were selling.
They were selling.
Yeah.
And we saw something very different, which was China was entering the WTO. China was trying to become the manufacturing plant of the global economy, in which was successful at that. And that drove a commodity super cycle at that time, in which, when you think about how interconnected gold and other commodities are, it's certainly the case. I mean, we've never seen a gold cycle that didn't drive a commodity cycle. And so, I do think this is going to be the case today. But when I look at the list of reasons why gold could potentially be entering a third gold cycle, right at a time when we've had a triple top in the gold price, and a lot of people have been very skeptical about the metal itself. to a degree that I haven't seen in the past, really, since the, maybe in the tech bust period or so. And now with crypto and other things kind of stealing the lunch of gold. But you think about, falling gold production across most of the major companies. We've got central banks accumulating the metal at record levels. We've had 60-40 portfolios. The traditional portfolio compositions starting to look at their treasury holdings and saying, well, maybe that's not really what protects us from the downside. It's not really owning U.S. debt. We have this ultra conservatism across most of of commodity businesses, in which we're not seeing gold discoveries come out. We're not seeing really the development of new projects that will create new producing assets in the gold space. And what I call this trifecta of macro imbalances, which is the debt problem of the 40s, the inflation of the 70s, and the valuation problem of the late 90s or the late 20s, before the Great Depression. And that creates these political constraints that I believe will unleash an inflationary regime. And so to me, this is, it's such an important chart to be thinking about.
Yeah. I want to point out a couple of things here for the audience. You mentioned the triple top, and I believe you've got a chart coming up somewhere where you're going to zoom in on that. But that chart does not include the big, more than decade-long pan and handle. We had a cup and handle forming, but now the handle is getting long. So if people can look at that area from like 2011, the peak, all the way to today, it sort of looks like a big pan with a handle on the end. And that's one of the most bullish formations there is, along with a triple top. That's one of the most bullish. I did an insider's video a couple of months ago on this, and I analyzed all of that. And now that handle and triple top looks like it could be forming into an inverse head and shoulders. And so with these, if the markets keep on rising, then gold will remain a little bit suppressed. But to me, that's your last opportunity to accumulate sub $2,000 gold. This opportunity isn't going to last forever. And once it breaks through that resistance of the triple top that is there, that resistance becomes support. It'll probably come back down and test it and then take off like a rocket. And you will never see sub $2,000 gold again. That will be a thing in history, like $20 gold.
It's crazy to think of that way, but it's certainly, just look at how, the upward pressure that you see after the onset of a cycle. And it's just, I think a lot of people are underestimating what we could see.
So this consolidation has really gone on since 2011. And I want to remind people that the longer consolidation goes on, the more pressure builds up, the more out of balance things are. At first, a consolidation is correcting. Something can run ahead of itself and consolidate. And that's sort of like this soft landing that the Federal Reserve keeps on wishing for. That's true. A consolidation. A crash is so this consolidation that's gone on since 2011, this sideways motion, while the currency supply keeps on expanding, and we've got inflation, and then we've got all these geopolitical things happening. All of this just stores energy. And when we finally break this triple top of hitting a price, when it busts through it, which it usually does on a triple top, doesn't usually turn into a quadruple top.
No.
The next time it touches that area, say goodbye to sub $2,000 gold.
Oh, we're on to something. And I'm happy to. Do you want to jump to that silver chart for?
No, keep on going through these gold charts and then go and we'll.
Oh, actually, that is my silver chart. The next one, unless you.
Oh, okay, that's fine. Then let's do it. Yes.
Because the most important thing is if we believe we're going to a gold cycle, and we looked at the gold to silver ratio at 80 or so, which is historically high, boy. If this really is a gold cycle, I don't think we've seen one in which silver doesn't lead the way to the upside. And I looked at this very last chart, and it's just monthly candles of silver going back to 2011 or so, 2010, 2011.
Well, 2011 is the peak, yeah.
The peak. And then you can see the monthly chart in which we've had we started there at this resistance that has lasted for over decades now. And we're very, very close to a breakout in this chart. This could happen any month, really.
Yes, it could. Yeah. And a stock market crash could. I don't have the stocks I have are long-term bets where I'm thinking that even if they go through a crash, I will use that as an opportunity to accumulate more, because these are bets for 2030, not for 2024, 2025, 2026. So like Warren Buffett once said, find a stock that you really like and buy it, and then pray that it goes down so that you can buy more. And that's exactly what I've been doing. Most of my portfolio, though, the most of my net worth is in precious metals. So anyway, yes, this is a very exciting chart. And this trend line is actually, I did this analysis of where gold and silver were in my last Insiders video. This is something I missed. And so when I saw you do this, I went, wow, I got to present that for everybody. So, yeah. Okay. So I guess that sort of is there anything you want to say here at the end? And
no, I think this, go ahead.
Tell us a little bit more about Crescat as well.
Oh, thanks for the opportunity to do that. Crescat is a global macro firm. We manage 3 different portfolios, and one of them is a precious metals portfolio as well, in which we invest in a lot of new discoveries and development stories in the industry, and it's a lot of exciting ways of taking a kind of an activist role into this industry, which I think it's lacking in a large way. So at Crescat, I'm really involved with the macro research in a large way, and we've got a lot of in-depth letters in our website, which is crescat.net, and put out a lot of charts on Twitter as well, and research in general, sharing our views about the economy and the global stage, and how we think things are going to be playing out in the near future. So thanks for the opportunity again, Mike. It was really great to be able to share a lot of this research here in your channel.
Well, no problem. I mean, I'm always looking for in-depth analysis. What I love about what you guys do there is that it is so macro, because macro, when you've got the fundamentals of something, like you're measuring the debt in the economy and inflation and all these very, very large things over a long time scale. So when you've got the fundamentals laid down, and then you use technical analysis on top of that. Fundamentals tell you where it is going ultimately, but it can't tell you when. It says it's got to return to an equilibrium sometime. So adding technicals to fundamentals, but I see these people that there's all these services that you can buy for technical trading and so on. And if they're so incredibly good, why aren't these guys all billionaires, and why are they putting their work into monthly subscriptions of this technical analysis to guide you and stuff? Because that's a lot of work. It's a lot of work doing these the YouTube videos and such, but I enjoy it. That was my mission, was to educate everybody, and I'm not working off of a subscription model, so I don't have to keep this up to make a living. It's anyway. So I like when somebody is taking a look at the really big picture, because when you're looking at global and you're looking over long time scales, it shows you, and you're looking at all these ratios, what is in balance and what is out of balance, and you can see that when you look over decades. And so I like that about your company, and I like that about what you do. So I hope you will join us again sometime.
Absolutely. And the fact that this is a generational wealth opportunity, in my opinion, despite the doom and gloom and the issues that we're referring to at the beginning of this video, this is a real opportunity, I think, to really capitalize on a lot of those macro imbalances. And so I think, to me, this is my major focus right now. And I think there's going to be a lot of interesting developments out of all this. And certainly gold would be, play a big role into that in my view.
Yeah, I feel exactly the same way. I really feel like there's something big that is going to be happening within just the next couple of years. And it is one of the greatest opportunities in history. So I want to thank everybody for watching. And I want to thank you again, Tavi, for making this appearance and sharing all those great charts and wonderful analysis with us. So we'll see you next time. Please like and subscribe to this video. Say goodbye, Tavi.
Thank you very much, Mike.
Okay, bye.